Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Rolls-Royce Holdings stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Rolls-Royce Holdings is a British aerospace and defense company. It designs, manufactures, and distributes power systems for the aviation and marine industry. In 1884, Henry Royce started an engineering business. In 1906, Charles Rolls and Henry Royce created a separate business to sell cars. In the 1970s, the company filed bankruptcy and stopped making cars. BMW acquired the name and currently makes Rolls-Royce cars. The company we are looking at does not manufacture cars. The last dividend they paid was in April 2020 and suspended future dividends due to weak sales from COVID. The company is headquartered in London, England, and was founded in 1904. The ticker trades on the OTC, Mexican Bolsa, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a large cap company, 12 billion market cap. They're trading at 148 pence, and they have 8.4 billion shares outstanding. We're going to look at the ticker that trades on the London Stock Exchange. So all the numbers in this video are in British pounds. 148 pence is pretty much 1.5 pounds. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So before COVID in 2019, they did have a lot of free cash flow, 900 million pounds. A really big negative in 2020, a smaller negative in 2021, then back to positive, 1.3 billion pounds in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative in 2019, 2020, and 2022. A really small positive in 2021. They have lots of write-offs, which is why they usually have negative net income. Revenue is the sales for the company, and that was highest in 2019 at 16.5 billion pounds. It fell in 2020 and 2021. It is coming back in 2022, 13.5 billion pounds. 13.5 billion pounds is equivalent to 16.8 billion US dollars. This is the company's income statement. The top line is the revenue, 13.5 billion in 2022. Let's dig into that number a little bit so we know what it is. Of the 13.5 billion of revenue, 6.3 billion is from selling equipment and 7.2 billion is from aftermarket. That's usually servicing the equipment. That's where all the profits are, the servicing part. That's why during COVID, they weren't making any money because planes weren't really flying, so they didn't need to be serviced. Companies like this don't really make too much money from selling engines. It's a lot of work. All the margins are in servicing. Because it's like selling a car to someone. That's a one-time purchase of the car. But servicing that car could be 10 years, maybe longer. And it's so much easier to service the car than to make it. Here's a breakdown of their revenue by country. So you can see they sell all over the world. 4.7 billion pounds in Europe. UK is their biggest. That's where they're located, 1.7 billion pounds. The second biggest country is the US, 4.3 billion pounds. So they have 4.6 billion pounds in North America. 900 million pounds in the Middle East. China is real big at 1.2 billion. Asia is 2.5 billion pounds. Africa is 280 million. Australia, New Zealand, 229 million. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue. Example of cost of revenue is the cost to make an engine. Then you have your gross profit, 2.8 billion. So you should look at the gross margins to see if they're getting better or worse. The way to calculate gross margin is gross profit over revenue. These are their gross margins in 2021. They were 19%. So they converted 19% of their revenue into gross profit. In 2022 it was 20%, so they're improving their margins. You would expect the higher the revenue, the better the margins, but that's not always the case. Admin cost is 1.1 billion. That probably includes payroll. R&D is 891 million. Here's how they calculate the 891 million pounds. The gross R&D, 1.3 billion. R&D is the process which a company uses to obtain new knowledge, and then it uses that knowledge to improve existing products or obtain new ones. Usually R&D is payroll, but it could be other things like software expenses. They received 359 million of contribution fees. This is funding from the government. Their net R&D is $928 million. They capitalize $131 million as intangible asset, and then there's amortization and impairments. That's how they ended up with $891 million. There's a gain of $48 million on joint ventures, operating profit of $837 million. So their operating margins are 6%, up from 5%. The way you calculate operating margin, it's operating profit, $837 million, over revenue. It's how well you convert revenue into operating profit. The higher the better. Below that is a gain of $81 million from the disposal of businesses. They received $355 million of interest on their investments. They paid $2.8 billion of interest on their debt. That's up a lot from last year of $1.1 billion. So their net financing costs are $2.4 billion. Here's a breakdown of that $2.4 billion. The $355 million they received, $35 from interest receivable. This is the interest they earn, but haven't received it yet. They haven't received the cash. $190 million gain in interest rate swaps, $106 million commodity swaps, $24 million in their retirement account. It's like a pension fund, the retirement scheme. They have a lot more financing costs. Interest payable of $343 million. This is interest that has been incurred, but they haven't paid it yet. Since they do business all over the world, they hedge against foreign currencies. There's a loss of $1.9 billion. Then there's a bunch of other smaller things. They had a loss of $1.5 billion. They received a tax credit of $300 million. So their loss is a little lower at $1.2 billion. Last year they had a loss before taxes and received a tax credit more than the loss. So they reported a net profit for the year of $124 million. Their loss per share in 2022 was 14 pence. Their gain per share in 2021 was 1.5 pence. That's their stock price, 148. That's just a coincidence. Now let's look at their balance sheet. Here's the asset section of their balance sheet. And they list items least liquid to most liquid, which is opposite of the US. The most liquid is cash, that's on the bottom, and the least liquid is intangible assets, which is on top. So they have intangible assets of $4.1 billion. Here's a breakdown of the $4.1 billion. Goodwill is $1.1 billion. Goodwill is the premium you pay when you acquire another company. Certification costs, $488 million. Development expenses, $1.7 billion. Customer relationships. When you acquire another company, sometimes you have to value what the customers are worth, which is an intangible asset. Software, $300 million, and other $400 million. The original value of these intangible assets was $8.1 billion. Some of these assets have been impaired or amortized, and that was $4 billion, the amortization. So the original value minus the amortization is the book value, what's on the balance sheet, $4.1 billion. Goodwill can't be amortized, it could be impaired. That's why there's very little, only $36 million in the bottom half. But the other assets, these numbers are much bigger. I know in the US, goodwill could only be impaired, not amortized. In 2004, they changed a rule where goodwill could only be impaired, not amortized. Prior to 2004, goodwill was amortized, but now it could only be impaired. I'm not sure if that's in every country. I know it's in the US. Below intangible assets are PP&E, that's $3.9 billion. Here's a breakdown of the $3.9 billion. The original cost is $8.6 billion. That includes land and buildings, $1.9 billion, plant and equipment, $5.2 billion, aircraft engines, $1 billion, and construction, $400 million. And some of these items have been impaired or depreciated. That amount is $4.6 billion. So the original cost minus depreciation is the book value, $3.9 billion. Below PP&E is right of use assets, $1.1 billion. Right of use asset is when a company leases an asset that's owned by another company. And that's $1.1 billion down here. Land and buildings, $276 million. Plant and equipment, $78 million. And aircraft and engines, $700 million. They have $422 million of investments in joint ventures, $36 million investments in other. Then they have other financial investments, $540 million. Deferred tax assets. When they do use the deferred tax asset, that will benefit them in the future. They'll make more money that year. It will lower their taxable income. They have $600 million in post-retirement scheme. This is like their pension plan. This is the excess of that scheme. So non-current assets, $13.4 billion. Non-current assets are assets that can be liquidated beyond 1 year. All that means it takes longer than 1 year to turn into cash. Current assets can be turned into cash within 1 year. And we start with inventory of $4.7 billion. That's up from $3.7 billion. Here's a breakdown of their inventory, the $4.7 billion. $500 million of raw materials, work in progress $1.6 billion. Work in progress is inventory that has begun the manufacturing process. So it's no longer included in raw materials, but they have to account for it somehow until it's completed. And when it's completed, then it goes to finished goods. That's $2.6 billion. They have $7 billion of accounts receivables or trade receivables. This is when they sold a product or service, but they haven't received payment for it. So it's what's owed to them. Contract assets. Contract assets are similar to accounts receivables, except it's conditional upon a contract, upon something happening. And they have $2.6 billion of cash. So their current assets are $16 billion. Total assets are $29 billion. Here's a breakdown of their liabilities. Borrowing and lease liabilities, $358 million. That's in current liabilities. Non-current borrowings are $5.6 billion. I'll show you the detail on this. Here's a breakdown of the $358 million and the $5.6 billion. So most of the $358 million are lease liabilities on land or buildings, aircraft engines, plant and equipment. They do have $2 million in overdrafts and $1 million in bank loans, but it's pretty small. They have much more non-current. They have a note that's due in 2024. It's a really small interest rate, below 1%. $800 million on a 2025 note, 3.6%. The highest interest rate is in 2027 at 5.75%. The one in 2028 is really low, 1.6%. And they have $1.5 billion of leases. That's what makes up the $5.6 billion. Other finance liabilities, $1 billion. Trade payables, this is like accounts payable. This is what they owe others for stuff they bought on credit, $7 billion. Contract liabilities, which is similar to accounts payables. It's just conditional on a contract. Then they have tax liabilities, what they owe the government in taxes. $600 million of provisions, so current liabilities is $14 billion. Non-current liabilities, we talked about borrowings. Other is $3.2 billion. Long-term accounts payable, $2.4 billion. Contracts, $7 billion. So non-current liabilities is $22 billion. Total liabilities is $35 billion. So net liabilities, which is assets minus liabilities, that's negative $6 billion. So they have $6 billion more liabilities than assets. In the US, we call this net assets. Net assets is assets minus liabilities. But it looks like in the UK, they call it net liabilities. This is the equity section of the balance sheet. $1.7 billion of called up share capital. These are shares they issued but are not fully paid yet. $1 billion of share premium. Share premium is a reserve account. The company can use it, but only for certain things. Their accumulated losses, which is a sum of all their prior net incomes minus the sum of the dividends they paid out, is $10 billion. So they're running a loss of $10 billion. So they have negative equity. We saw that earlier, their net liabilities, negative $6 billion. Let's look at their statement of cash flows. The statement of cash flows starts with the operating section, then investing, then financing. This is the operating section. The way they calculate operating cash flow is a little different in the UK than the US. In the US, you start with net income, then add back the non-cash items on the income statement. And then you adjust for changes in working capital. There are some similarities. In the UK, they start with operating profit, not net income. Then they add back the depreciation and amortization. They adjust for changes in working capital. It looks like they added a bunch of inventory in 2022, $887 million. That's a cash outflow. But when they use the inventory to sell products, it'll be a cash inflow. They had a $1.8 billion cash inflow from contract assets and liabilities. So in 2022, they had a cash inflow of $1.85 billion. Last year was a cash outflow of $259 million. This is their investing and financing section from their statement of cash flows. Let's look at this $1.4 billion on the disposal of businesses. It looks like they disposed of one of their business units and received $1.5 billion. There were costs associated with that of $45 million and another $21 million outflow. That's how they got the $1.4 billion. They disposed of their ITP Aero division. Last year they had a cash outflow of $400 million in their investing section. They bought $328 million of PP&E. They added intangible assets of $231 million. In the financing section, they had a cash outflow of $2.9 billion. They paid back $2 billion on loans, then some other smaller items. In 2021, they had a cash outflow of $88 million because they added $2 billion of loans. They paid that back in 2022. Let's look at the capital structure. They have negative $6 billion of equity, $6 billion of debt. They're 0% equity, 100% debt. And their net debt is $3.6 billion. I use the middle whack on Finbox, 13%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's $15 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $13 billion. We divide that by 8.4 billion shares. And we get a calculated stock price of 159 pence. They're trading at 148 pence. So they're trading at a 7% discount. It's a buy according to the model. 12 analysts projected their 2025 revenue to be £15.6 billion. The projection for 2024 is $14.7 billion. For 2023, it's $13.7 billion. I continued this trend into 2026 and I got $16.5 billion. That's how I got their future revenue estimates. They convert 9% of their revenue into free cash flow in 2022, so I multiplied their future revenue estimates by 9%. That's how I got their future free cash flows. The website Simply Wall Street values the company at £2, so they're saying it's 25% undervalued. 17 analysts priced this stock and the average price target is 146 pence. This is where the stock has been trading the last 5 years. It did hit £4 in mid-2018, and I think it fell below 30 pence at the end of 2020. That would have been a great time to get it. It's come up a lot since then. I was thinking about buying it when it fell below 100 pence, but I get a little weary about buying OTC stocks. They used to pay a decent dividend. It was over 3% in 2015. The forecast is for the yield to be 1.2% by 2025, but it's currently 0 right now. They have a beta of 1.66, so the stock moves a little more than 1.5 times the market. It's gone up 56% in the past 52 weeks, while the S&P is down 7%. The 52-week high is 240 pence, and the stock is trading above its 50-day and 200-day moving average. This is a pretty popular stock. 50 million shares are traded each day. Of the 8.37 billion shares outstanding, 8.2 billion are on float, and 64% are held by institutions. If you invested $10,000 into RICE 10 years ago, you'd be at $1,200 today, an 88% loss. There's been only insider buying, no selling. That's a really good sign when you see that. 75% of the companies held by institutions, 24% by the general public, 0.7% by the employees, 0.4% by public companies, 0.2% by the British government, 0.05% by private companies, and 0.03% by insiders. Their employee count has gone down the past few years. They're currently at 42,000 workers. The biggest shareholders Causeway at 8%, then BlackRock, Massachusetts Financial Services, Vanguard, Franklin Resources, thru, Fidelity, HBOS, Norgus, and Schroeder Investment. Here's a breakdown of their order backlog. 37 billion pounds of backlog within 5 years. 26 billion in aerospace, 8 billion in defense, and 4 billion power systems. After 10 years, 23 billion, so it's a total backlog of 60 billion pounds. So to summarize, I have them trading at a 7% discount, and I do like this stock a lot. I'd probably buy it if it wasn't OTC. And they are one of the biggest aircraft engine manufacturers in the world. And that's an industry that's always going to be around. I rank their free cash flows and revenue 7 out of 10, their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.